Imagine believing your whole life that silver is the ultimate safe haven asset, the one metal that would protect your wealth when currencies fall apart, only to realize that for more than a decade the silver market has quietly moved against you. Between 2011 and 2020, silver prices fell nearly 70% from their peak, not because global demand disappeared, but because institutional trading power slowly reshaped the market in ways the average investor never saw coming. You didn't just lose 25% or 40% of your savings. Many investors watched their portfolios bleed by 65.7% while still believing the rebound was just around the corner. At first, the numbers looked harmless. Analysts said industrial demand would grow by 5.3% per year. Solar panels would consume record silver volumes, and inflation would eventually push prices up by 8.5% or even 12.4%. But year after year, the opposite happened. In 2013 alone, silver dropped more than 35%, and between 2014 and 2019, it failed to recover even 30% of its former value, creating a psychological trap where investors kept averaging down, believing every dip of 7.2% or 9.1% was a buying opportunity. Then came the illusion of scarcity. Headlines screamed that physical silver was disappearing, mints were running out, and premiums were exploding by 22% or 35% above spot price. Yet the paper market continued to trade volumes hundreds of times larger than real metal supply. On the COMEX Futures Exchange, the ratio of paper silver contracts to physical deliverable silver often exceeded 300 to 1, meaning for every real ounce, more than 300 claims existed. That imbalance quietly crushed price discovery and turned genuine investors into statistical noise. The most painful part is how hope was engineered. Every time silver rose 6.8% in a single week or 11.3% in a single month, social media erupted with predictions of a breakout, $50 targets, and returns of 140% or 210%. But each rally was met with heavy institutional selling, pushing prices back down by 18%, 23%, or even 41% within months. What felt like manipulation slowly became routine volatility disguised as a free market. By 2020, many silver holders had already lost more than half their original investment. A person who invested $10,000 near the 2011 peak saw that amount shrink to barely $3,200 at the bottom, a real-world loss of 67.8%. Inflation, meanwhile, eroded purchasing power by an additional 21.4%, meaning even a later recovery of 45% could not restore the original value. The damage wasn't just financial, it was emotional. A decade of waiting for a future that never arrived. And yet the story keeps repeating. New investors enter after seeing silver spike 27% in a year, convinced they caught the bottom, only to experience another drawdown of 19.6% within months. They don't realize that large banks and hedge funds control most futures volume, shaping short-term moves that wipe out small traders with surgical precision. It's not a conspiracy theory anymore. Regulatory records show repeated cases of precious metals price manipulation with fines exceeding hundreds of millions of dollars. So this is why it truly sucks to be a silver investor. You're told the fundamentals are perfect, demand is rising by 4.9%, supply is tightening by 3.1%, and inflation is stealing 7.7% of your money every year. Yet the market never seems to reward your patience. You wait 8 years for a 60% recovery, only to realize that your real wealth is still down 35% after inflation. You didn't fail because silver failed. You failed because the game was never designed for you to win. When 2020 ended, silver investors thought the nightmare was finally over. Prices had surged more than 47% in a single year, the strongest annual gain since 2010, and the world was drowning in stimulus money. Central banks slashed interest rates close to 0%. while global money supply expanded by over 25%, convincing everyone that silver was about to explode. Many believed a breakout of 85% or even 120% was no longer a dream but a mathematical inevitability. Yet what followed was not a revolution, but a slow psychological breakdown that in 2021 silver failed to hold momentum. After touching nearly $30, it slid back by roughly 22% within months, even as inflation in the United States crossed 7% and remained above 5.4% across most developed economies. Industrial demand was rising by about 8.3%, driven by solar and electric vehicle manufacturing, yet the price barely reflected it. By the end of 2021, many investors were still down more than 38% from the 2011 peak, realizing that a single strong year could not repair a decade of erosion. Then came 2022, the year that broke confidence. The Federal Reserve launched the most aggressive rate hiking cycle in over 40 years, pushing policy rates from near zero to above 4.25% within 12 months. Silver responded brutally, collapsing nearly 29% from its 2021 highs, while real yields turned positive by about 1.7%. Investors who expected silver to hedge inflation instead watched it underperform even basic treasury bonds by more than 14%. It wasn't just a price drop. It was the collapse of the metal's entire narrative. By 2023, hope was already fragile. Prices rebounded around 17.6% during the year, driven largely by expectations that rate cuts were coming. But physical demand rose by only about 4.1%, while ETF holdings declined nearly 11%, signaling that institutional players were exiting. Retail investors, however, kept buying, paying premiums of 18% to 32% above spot for coins and bars, unknowingly locking in losses before the market even moved. In 2024, silver flirted with recovery again, climbing roughly 21% as inflation stabilized near 3.4% and solar demand grew by an estimated 10.2%. Analysts projected a supply deficit of nearly 3.6% of total annual output, enough, they claimed, to send prices surging another 60%. But once again, futures markets absorbed the pressure. Paper trading volumes expanded by over 19%, keeping prices suppressed despite tightening physical availability. Now, in 2025 and early 2026, the pattern feels painfully familiar. Silver trades only about 12% higher than its 2020 average, while cumulative inflation since then exceeds 27%. That means even the patient investor who held through the entire recovery is still down more than 15% in real terms. You didn't just miss opportunity, you paid for it, through inflation, opportunity cost, and a market structure that never let your conviction turn into real returns. This is why the pain never ends. From 2020 to 2026, silver delivered volatility of nearly 42% year to year, yet produced real gains close to zero. You survived rate hikes of 425 basis points, inflation spikes of 9.1%, paper-to-physical trading ratios still hovering above 250 to 1, and endless promises of a breakout that never materialized. You didn't invest in a metal, you invested in a system designed to keep you waiting. By 2024, silver investors were once again told that the turning point had finally arrived. Global industrial demand was reported to be up by about 10%, largely driven by solar panel manufacturing and EV infrastructure, and analysts projected a physical supply deficit of nearly 3.5% of annual mine output. Prices reacted with a short-term rally of around 21%, pushing many to believe that the long-awaited 85% breakout was just months away. Yet behind the scenes, futures market volume expanded by almost 20%, meaning paper claims were once again absorbing the pressure that physical scarcity was supposed to create. Midway through 2025, the illusion started cracking. Inflation across major economies cooled to the 3.2% to 3.5% range, while central banks kept policy rates above 5% far longer than expected. Silver slipped back by nearly 18% within 5 months, erasing most of the previous year's gains. ETF holdings dropped by roughly 9.7%, signaling that institutional investors were quietly walking away while retail buyers continued paying premiums between 15% and 28% over spot, effectively locking themselves into another cycle of underperformance. Entering 2026, the numbers painted a brutally honest picture. Since the start of 2024, silver's nominal return sat near 12%, while cumulative inflation over the same period exceeded 14%. In real terms, that means patient holders were still losing purchasing power despite enduring extreme volatility of more than 38% year to year. Even with global silver demand rising around 5.1% annually and mine supply growing only about 2.2%, prices failed to respond in any meaningful way, crushed under a paper-to-physical trading ratio that remained above 250 to 1. By early 2026, the story had become painfully repetitive. Every 9% rally was followed by a 14% pullback. Every breakout attempt was smothered by heavy selling from derivatives markets. The investor who entered in 2024 hoping for a 60% upside instead found himself staring at a real loss of nearly 7% after inflation. 2 years of patience, hundreds of news headlines, and endless expert predictions had once again delivered nothing but delay. This is why the 2024 to 2026 chapter feels worse than any before it. Not because silver collapsed, but because it refused to win. It drifted, teased, and exhausted its believers with just enough movement to keep them trapped. The metal that was supposed to defend against currency decay ended up decaying alongside it, leaving investors with one final realization. The market was never broken. It was simply never built for them.